Hey YouTube, this is Scott at Love for Crypto and welcome to Blockchain for Dummies, IBM's limited edition, read by myself, Scott Pratt. The Blockchain for Dummies video series is going to consist of 6 videos, and within the 6 videos will be the 6 chapters of the book. So this is part 1, where we'll be going through chapter 1, Grasping Blockchain Fundamentals. We'll be tracing blockchain's origin, the shortcomings of the current transaction systems, the emergence of Bitcoin, the birth of blockchain, revolutionizing the traditional business network, exploring a blockchain application, recognizing the key business benefits, and building trust with blockchain. So that's all video 1, and the other chapters will be covered in the rest of the videos. So without further ado, we'll get straight into chapter 1. Grasping Blockchain Fundamentals. So the book begins. Blockchain is a shared distributed ledger that facilitates the process of recording transactions and tracking assets in a business network. An asset can be tangible, a house, a car, cash, land, or intangible, like intellectual property, such as patents, copyrights, or branding. Virtually anything of value can be tracked and traded on a blockchain network, reducing the risk and cutting costs for all involved. That's basically the elevator speech for blockchain. In the rest of the chapter, we'll provide additional details to help you more fully appreciate the technology and its potential for streamlining business operations. Tracing blockchain's origin. You can gain a deeper understanding of blockchain by exploring the context in which it was developed, the need for an efficient, cost-effective, reliable and secure system for conducting and recording financial transactions. In this section, I'll provide the context that's described and the characteristics of blockchain that make it such a suitable solution. So the shortcomings of the current transaction systems. Throughout history, instruments of trust such as minted coins, paper money, letters of credit, banking systems, they've all emerged to facilitate the exchange of value and protect buyers and sellers. Important innovations including telephone lines, credit card systems, the internet and mobile technologies have improved the convenience, speed and efficiency of transactions while shrinking and sometimes virtually eliminating the distance between buyers and sellers. Still, many business transactions remain inefficient, expensive and vulnerable, suffering from the following limitations. Cash is useful, but only in smaller local transactions and relatively small amounts. The time between the transaction and settlement can be a relatively long time. It's too long for the time we're living in. Duplication of effort, the need for third-party validation and or the presence of intermediaries all adds to the inefficiencies. Fraud, cyber attacks and even simple mistakes add to the cost and complexity of doing business, and they expose all participants in the network to risk if a central system such as a bank is compromised. Credit card organisations have essentially created walled gardens with a high price of entry. Merchants must pay the high cost of onboarding, which often involves considerable paperwork and time-consuming vetting process. Half of the people in the world don't have access to a bank and have had to develop parallel payment systems to conduct transactions. That's ridiculous. We all know that Bab's going to help with that, but that's getting ahead of ourselves for these videos. The transaction volumes worldwide are growing exponentially and will surely magnify the complexities, vulnerabilities, inefficiencies and costs of current transaction systems. The growth of e-commerce, online banking and in-app purchases and the increasing mobility of people around the world have fueled the growth of transaction volumes, and transaction volumes will explode with the rise of the Internet of Things. Autonomous objects such as refrigerators that buy groceries when supplies are low, cars that deliver themselves to your doorstep. Literally, they're going to drive to you while stopping for fuel along the way. Autonomous vehicles, this is going to be crazy, and this is the future. To address these challenges and others, the world needs payment networks that are fast and provide a mechanism that establishes trust, requires no specialized equipment has no chargeback or monthly fees, and provides a collective bookkeeping solution for ensuring transparency and trust. And that's where the emergence of Bitcoin comes in. One solution that has been developed to address the complexities, vulnerabilities, inefficiencies, and cost of current transaction systems is Bitcoin, a digital currency that was launched in 2009 by a mysterious person or persons known only by the name Satoshi Nakamoto. Unlike traditional currencies, which are issued by central banks, Bitcoin has no central monetary authority. No one controls it. Bitcoins aren't printed like dollars or euros, they are mined by people, increasingly by businesses. It were all running computers all around the world. They're using software that solves mathematical puzzles rather than rely on a central monetary authority to monitor, verify and approve transactions and manage the money supply. Bitcoin is enabled by a peer-to-peer computer network made up of its users, machines akin to the networks that underpin BitTorrent and Skype. Bitcoin has several advantages over the other current transaction systems, including the following. So we run through these now. The cost effectiveness. Bitcoin eliminates the need for intermediaries. Efficient. The transaction information is recorded once and is available to all parties through the distributed network. It's safe and secure. The underlying ledger is tamper evident, and a transaction can't be changed. It can only be reversed with another transaction, in which case both transactions are visible. The birth of blockchain. Bitcoin is actually built on the foundation of blockchain, which serves as Bitcoin's shared ledger. Think of blockchain as an operating system, such as Microsoft Windows or Mac OS, and Bitcoin as only one of many applications that can be run on that operating system. So Bitcoin to blockchain is basically like email was to the internet in the 90s. It was very early days. During the early stages of the internet, people were just sending emails. During the early stages of blockchain, there was only Bitcoin to use. Now we're seeing many more coins emerge, many more technologies emerge, and it's only going to snowball down the line. Blockchain provides the means for recording Bitcoin transactions, the shared ledger, but this shared ledger can be used to record any transaction and track the movement of any asset, whether tangible, intangible, or digital. For example, blockchain enables securities to be settled in minutes instead of days. It can also be used to help companies manage the flow of goods, related payments, or enable manufacturers to share production logs with original equipment manufacturers and regulators to reduce production recalls. The takeaway lesson from this section is that Bitcoin and blockchain are not the same. Blockchain provides the means to record and store Bitcoin transactions, but the blockchain has many uses beyond Bitcoin. Bitcoin is only the first use case for blockchain. Like we said, email was the first use case for the internet. It wasn't the only. Revolutionizing the traditional business network. With traditional methods for recording transactions and tracking assets, participants on a network keep their own ledgers and other records shown in the picture on the left in figure 1.1. This traditional method can be expensive, partially because it involves intermediaries that charge fees for the services. It's clearly inefficient due to the delays in executing agreements and the duplication of effort required to maintain numerous ledgers. It's also vulnerable because if a central system, for example a bank, is compromised due to fraud, cyber attack, a simple mistake, the entire business network's affected. The picture on the right in figure 1.1, however, represents business network that use the blockchain. The blockchain architecture gives participants the ability to share a ledger that is updated through peer-to-peer replication. Every time a transaction occurs, peer-to-peer replication means that each participant node in the network acts as both publisher and a subscriber. Each node can receive or send transactions to other nodes, and the data is synchronized across the network as it's transferred. The blockchain network is economical and efficient because it eliminates duplication of effort, it reduces the need for intermediaries, it also less vulnerable because it uses consensus models to validate information. Transactions are secure, authenticated, and verifiable. The participants in both transaction systems are the same. What has changed is that the transaction record is now shared and available to all parties. The blockchain network has the following key characteristics. Consensus. For the transaction to be valid, all participants must agree on its validity. See chapter 2, which will be the next video, for more about consensus mechanisms. The provenance. Participants know where the asset came from, how its ownership's changed over time. It's completely transparent. Immutability. No participant can tamper with a transaction after it's been recorded onto the ledger. If a transaction is in error, a new transaction must be used to reverse the error, and both transactions are then still visible. You see the error and you see the new transaction that reversed the error. Finality. A single shared ledger provides one place to go to determine the ownership of an asset or the completion of a transaction, be it simple value of transaction or liquidity or an actual smart contract and an agreement. Ownership and completion of the transaction is there for all to see in exactly the same place for everyone. So now we're going to move on to exploring a blockchain application, and the example used is car companies. Car companies make leasing a vehicle look easy, but in reality it can be quite complicated. A significant challenge faced by today's car leasing networks is that even though the physical supply chain is usually integrated, the supporting systems are often fragmented. Each party within the network maintains its own ledger, which then leads to it taking days or weeks to synchronize, sometimes even months in some cases, especially in the trade industry. By using a shared ledger on a blockchain network, every participant can access, monitor, and analyze the state of the vehicle, irrespective of where it is within its life cycle. So here we have tracking ownership of a vehicle without blockchain, from manufacturer to dealer to leasing company to leasee to the scrap merchant. All the details and information of them transactions, they're all put into in-house ledgers that are then sent to the regulator, and anyone wanting to look at anyone else's ledgers or the previous or future transactions needs to go to the regulator's in-house ledger. With blockchain, network participants can interact as follows. Number 1, on the graph, as you can see, the government, regulator or manufacturer creates and populates the registration for the new vehicle on the blockchain, transfers the ownership of the vehicle to the manufacturer. Number 2, the manufacturer adds the make, model and vehicle identification number to the new vehicle template within the parameters allowed by the smart contract, which is a digital agreement or a set of rules that govern a transaction. See chapter 2, which will be video 2, for more details on governing transaction and smart contracts. So number 3, the dealer can see the new stock availability, and ownership of the vehicle can be transferred from the manufacturer to the dealership after a smart contract is executed to validate the sale. Number 4, the leasing company can see the dealer's inventory. Ownership of the vehicle can be transferred from the dealer to the leasing company after the smart contract is executed to validate the transfer. Number 5, the leasee can see the cars available for lease, complete any form required to execute the lease agreement. Finally, number 6, the leasing process continues between various leasees and the leasing company until the leasing company is ready to retire the vehicle. At this point, ownership of the asset is transferred to the scrap merchant, who, according to another smart contract, has permission to dispose of the vehicle. That is the full life cycle of the vehicle, as seen in the graph. Recognizing the key business benefits for business, blockchain has the following specific benefits. Time saving is a massive one. The transaction times for complex multi-party interactions are slashed from days to minutes. Transaction settlements faster because it doesn't require verification by a central authority. It reduces friction a ridiculous amount. Cost savings. A blockchain network reduces expenses in several ways. Less oversight is needed because the network is self-policed by a network of participants. all of whom are known on the network. Intermediaries are reduced because participants can exchange items of value directly between each other peer-to-peer. Duplication of effort is eliminated because all participants have access to the shared ledger. Tighter security. Blockchain security features protect against tampering, fraud, and cybercrime. If a network is permissioned, it enables the creation of a members-only network with proof that members are who they say they are and that goods or assets traded exactly as represented. So a little tip to bear in mind here, not all blockchains are built for business. Some are permissioned while others aren't. A permissioned network is critical for a blockchain for business, especially within a regulated industry. Enhanced privacy. Through the use of IDs and permissions, users can specify which transaction details they want other participants to be permitted to view. Permissions can be expanded for special users such as auditors, like they may need access to more transaction details than other people. So you control the permissions on the privacy and permission network. Improved auditability. Having a shared ledger that serves as a single source of truth improves the ability to monitor and audit transactions. And finally, increased operational efficiency. Pure digitization of assets streamlines transfer of ownership, so transactions can be conducted at a speed more in line with the pace of the going business. Increased operational efficiency. Pure digitization of assets streamlines transfer of ownership, so transactions can be conducted at a speed more in line with the pace doing business. Chapter 2 goes into more detail on what makes a blockchain network ideal for business. We'll move on to building trust with blockchain. So blockchain enhances trust across a business network. It's not that you can't trust those who you conduct business with, it's that you don't need to when operating on a blockchain network. Blockchain is particularly valuable at increasing the level of trust among network participants because every transaction builds on every other transaction. Any corruption is readily apparent as everyone is made aware of it. This self-policing can mitigate the need to depend on current level of legal or government safeguards and sanctions to monitor and control the flow of business transactions. The community of participants does that on blockchain. Where third-party oversight is required, blockchain reduces the burden on the regulatory system by making it easier for auditors and regulators to review relevant transaction details and verify the compliance. Blockchain builds trust through the following 5 attributes. Distributed and sustainable. The ledger is shared, updated with every transaction and selectively replicated among participants in near real time. Because it's not owned or controlled by any single organization, the blockchain platform's continued existence isn't dependent on any individual entity. Secure, private, and indelible. Permissions and cryptography prevent unauthorized access to the network and ensure that participants are who they claim to be. Privacy is maintained through the cryptographic techniques and/or data partitioning techniques to give participants selective visibility into the ledger. Both transactions and the identity of transacting parties can be masked. After conditions are agreed to, participants can't tamper with a record of the transaction. Errors can be reversed only with a new transaction. Transparent and auditable, because participants in a transaction have access to the same records. They can validate transactions and verify identities or ownership without the need of a third-party intermediary. Transactions are time-stamped and can be verified in near real time. Consensus-based and transactional. All relevant network participants must agree that a transaction is valid. This is achieved through the use of consensus algorithms. Each blockchain network can establish the conditions under which a transaction or asset exchange can occur. It's orchestrated and flexible because business rules and smart contracts that execute based on one or more conditions can be built into the platform. Blockchain business networks can evolve as they mature to support end-to-end business processes and a wide range of activities. Right guys, that brings us to the end of chapter 1. Grasping blockchain fundamentals. We read through tracing blockchain's origin, the shortcomings of the current transaction systems, the emergence of Bitcoin, the birth of blockchain. We had a read through revolutionizing the traditional business network, exploring a blockchain application, recognizing the key business benefits, and building trust with a blockchain. I hope you enjoyed the video. Feel free to keep going back through it. Feel free to turn the audio off and just read through it yourself. It's there to educate people who don't really understand what blockchain is, or they're just sick of hearing that Bitcoin thing on the news and it not really being explained. This video series is here to enlighten people that this technology is about to change the world, and in a way no one thought possible a couple of decades ago. So it's exciting times. It really is exciting times, and we're glad to have you here on the channel. If you did like the video, don't forget to go down into the comments, give us a thumbs up, drop a comment, let us know what you thought, let us know what you think. Have IBM done a good job here? Was that a decent chapter? Could they have improved it? Could I read it better? Let me know. Also, you can follow us on Twitter, Instagram and Facebook for more content. Some of it's laughy and jokey. I don't know if you saw the Jurassic Park video yet, but we like to do a little bit of comedy now and then, as well as shared official and legitimate positive news. So yeah, that was Blockchain Fundamentals, Chapter 1 of IBM's Blockchain for Dummies Limited Edition by Manav Gupta. Thanks for watching. Bye.